I do expect a pretty significant run here. For Bitcoin, most of the indicators that I tracked point to being fairly mid-cycle in terms of the bull run. And so, I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can, show us, for example, how much long-term holders are selling into the current strength. Because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And so I still think my expectation is there's room to run, both from the liquidity side being fairly constructive, so that should help demand. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months.
Bitcoin is only halfway through its bull run, with the next 18 months looking extremely promising. Renowned macro analyst Lyn Alden expects its price to head towards at least $100,000 by the end of 2025. In her latest interview, Alden points out that as more people turn to a safe haven asset like Bitcoin, its price is only set to surge much higher. Alden explains that Bitcoin is poised to explode for two basic reasons. First off, demand has essentially 10x'd, with 9,000 to 10,000 Bitcoin being bought every single day since the approval of the Bitcoin ETFs. So we've seen a demand shock. Secondly, with the 2024 Bitcoin halving, the supply of Bitcoin is cut from 900 new Bitcoin being created each day to just 450, so a supply shock. As only 450 Bitcoin are being created each day, with 9,000 to 10,000 Bitcoin being bought, there is literally 20 to 30x more demand than supply of Bitcoin. This means the price has to rocket upwards to meet a new equilibrium. Make sure to stick around to the end of the video, where Lyn breaks down why Bitcoin's future looks so bright in light of the grander macroeconomy. Also guys, if you enjoy finance content, consider subscribing to the channel or liking the video. It's free and you can always change your mind. Now here's Lyn Alden's analysis on why Bitcoin is positioned for significant growth.
Owning things like energy stocks, for example, or direct oil exposure, or gold or Bitcoin. These are the types of assets that I find more interesting to match with my equities in this environment, because the entire 60-40 portfolio is kind of designed around that structural disinflation, structural declining interest rates. And as we go to a new period, I think these other assets offset and kind of smooth out an equity portfolio better than just long duration bonds, which is I think Bloodsport's a good phrasing for it. I call it the too hard pile. I put bonds in the too hard pile because if bond yields go up, there's other asset classes that I think will be more affected. And if bond yields go down, as Luke said, I'd want to own things like gold and Bitcoin. I wouldn't want to own, whatever move I could get in that long duration treasury yield. There's other assets that I'd probably want to own. And it also depends on what reason it was for those moves. And so I've just not been really using long duration bonds as a portfolio segment, even though I am acutely aware of things like recession risk or inflation risk. I find that other assets work better with the equity. I do expect a pretty significant run here. For Bitcoin, most of the indicators that I tracked point to being fairly mid-cycle in terms of the bull run. I still think the next 18 months look favorable for the asset. Again, it tracks global liquidity pretty well. The on-chain indicators can, show us, for example, how much long-term holders are selling into the current strength. Because even though obviously Bitcoin supply is constrained, if the price goes up, 3x or 5x in a fairly short period of time, you generally see some of those older coins start to come to market and start meeting that new demand. And we've seen some of that, but so far we've seen less of that in this cycle than in prior cycles. And so I still think my expectation is there's room to run, both from the liquidity side being fairly constructive, so that should help demand. And I still think that there has to be a higher price to unlock some of these older coins to meet that demand. And so I would be surprised not to see six-figure Bitcoin over the next 18 months. Obviously anything's possible, but I'm bullish on both gold and Bitcoin in that time frame. I've pointed out in some of my newsletters the concerns people had in the 80s and early 90s around the debt levels. So, for example, the famous debt clock went up in, like, what was it, 1988 or 89, and then Ross Perot ran the most successful independent presidential campaign in the early 90s, largely based on debt and deficit. That was kind of a main issue of his. And if you look at the chart of interest expense as a percentage of GDP, that was peak interest expense, because even though federal debt was still fairly low, they had ultra high interest rates, and therefore they had they looked like they had a spiral start. They had the fall of the Soviet Union, they had the opening up of China to the world, and then they had this kind of 30-year stretch of major globalization, interest rates falling from double digits all the way down to basically zero. And so, if I were to describe the fiscal problem in one kind of frame, would be, we've had 40 years of rising debt to GDP, but it's been offset by 40 years of falling interest rates until we hit zero. And so if we just go, sideways now, let alone up, but if we just go sideways now, then we no longer have that offset of interest rates compared to the debt. And a lot of this is locked in, and now we're well over, like 100% debt to GDP. The lessons we learned is that debts and deficits don't matter. That's how a lot of people took that, right? They say, look, those people were wrong. Yeah. And I think the pendulum has swung so far that now people are in the mindset that debts and deficits don't really matter, and it's starting to matter. And so, for example, we've had the longest period of the Conference Board leading indicator being like in recession territory, and yet not having an official declared recession. We've had, PMIs went down. Normally bond yields go down when that happens. Instead, bond yields went up. And as Luke pointed out, that chart, gold and real rates diverging. The fact that the Federal Reserve had to come in and stop reducing their balance sheet in 2019 while there's still an economic expansion. These are all kind of things that start happening, and it's not like one Boolean outcome, like we go from not in fiscal dominance to permanently in fiscal dominance. But over the past, call it 5 years, there's been a number of pretty clear indicators that various signs of fiscal dominance and EM-like characteristics in the US are building. And so I don't think it's a matter of like, okay, here, like 2028 is like the date that we're going to enter fiscal dominance. My view is basically ever since 2019 or so, we've roughly been flirting with it. That's fiscal is now a bigger factor than it normally is, and we don't have that 40-year offset in lower interest rates to offset that. And if somehow, let's say if AI comes and just completely gives us this massive disinflationary force and just kind of holds down, they're able to have low interest rates despite fairly high money supply growth. Well, then I still want to be in kind of the same assets that I'm in anyway, which I'd rather be in gold and Bitcoin than treasury bonds, for example, in that environment. Fiscal dominance would be less inflationary if it imploded the private sector. So, for example, by raising rates so quickly, they blew out interest expense, but they also killed some of the banks. But when those banks started to fail, instead of letting deposits that are uninsured go bust, they bail out the deposits. And so they kind of soften what happens on the private sector while putting the gas on the public side. And that's where you get fiscal dominance being more inflationary. So it could include things like SLR rules changes, kind of, financial jargon that helps banks hold more treasuries, which is also basically what they did in the 1940s. It wasn't just the Fed monetizing all the treasuries, it was other pools of capital, including banks. And banks, because they have fractional reserve, policies, that they can hold quite a bit of treasuries depending on regulations around them, especially if those treasuries are shorter term. I think we're going to have higher highs and higher lows of inflation than we had in the prior decade. That's how I would describe a secular inflation. And I think the right question is, what's going to happen with inflation the next time we have an upcycle in PMIs, for example, manufacturing purchasing managers index? Because I think that's the real test. You can get inflation down temporarily if you're willing to have a recession, if you're willing to disinflate enough, and that's kind of the pseudo cycle we've been on. It's obviously been offset by fiscal, as we've been talking about. So they've not gotten it down to 2%, but they have muted it significantly. We're starting to see early signs of PMI reacceleration, kind of rotation in what sectors are doing well. And so I think the big test is, if we get an upcycle in PMI, what does inflation do? My expectation is that inflation goes up or stays sticky when we get that next PMI rise. I think recession or no recession is now more sector specific. when you have this big of a gap between fiscal and monetary, you can get sharply divergent sector performance. So, for example, commercial real estate's in a depression, whereas other areas are in an expansion, right? And so I think that we could see a rotation. For example, we are starting to see some weakness in the labor market. You're up from 3.4% unemployment to 3.8. Around the margins, some of that's getting weaker, perhaps, even as we see reacceleration in some of the harder stuff like manufacturing PMIs. So I would have not super high conviction on that, because I think even if we do get a recession, it looks different when you're pre-stimulating by $1.6 trillion in deficits. I think you enter a type of recession that looks like a fiscally dominant recession. So my view is even somewhat divorced from the business cycle, even though I'm, every 2 weeks, I'm kind of trying to aggressively map out, whether the economy is expanding or contracting. But I think that overall, when people ask about recession, they often think it's going to look like global financial crisis. It's going to look like COVID. It's going to be this big disinflationary recession. Whereas my expectation is it looks more like a 2001 recession, or it looks more like a 1970s recession. There's different magnitudes it can look like, but I think it looks more like those other types of recessions, even if you were to get one. But yeah, my answer would probably be I would expect higher inflation before recession, but not super high conviction. A challenging thing is that the dollar index is so tied to the euro. That particular currency pair weighs very, very heavily. So I am more interested on a currency by currency basis. Like I think some of the Latin American currencies are less weak than people are maybe accustomed to at the current time. I think that the worst the dollar move is probably behind us, which should be somewhat beneficial for all these entities that have these dollar-based debts that are maybe not in the most dire straits, but that are kind of teetering. I think a lot of them have gotten through the worst of it.
So there's Lyn Alden sharing her optimistic views on Bitcoin and its potential to revolutionize traditional monetary systems. As she gives us a breakdown on what's currently happening in the macro cycle, she asserts that traditional monetary systems have been long overdue for renovation through Bitcoin. The problem is that for 40 years, debt has been rising whilst interest rates have been falling. With interest rates now at zero, Lyn stresses that things have gone too far, leading to a situation where fiscal matters are starting to have an impact on the majority, which is why there is a drastic need for change through a newer and better monetary system. Ultimately, Bitcoin's attributes of decentralization, transparency, security, and inclusivity position it as a savior for the financial system, offering solutions to long-standing issues and paving the way for a more equitable and resilient financial future. Before we go, a quick reminder for those who are keen on staying updated in the fast-paced world of crypto and Bitcoin. Consider subscribing to our daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis trusted by over 60,000 subscribers for insightful crypto investment information. Click the first link in the description to join our community and elevate your crypto investment knowledge today. Anyway guys, hope you all enjoyed today's video and that provided you with some value. I'll see you all in the next one, and as always, all the best.